and here's why. We intend to tell you why they want the gold, what are the possibilities, possible outcomes, and what would be the flip side if it didn't turn out to be as bullish as it looked.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the Gold Fix Market Rundown. Big day yesterday on multiple levels, and we're going to talk about that. The title tentatively is Someone Wants the Gold in a Big Way, and here's why. We intend to tell you why they want the gold, what are the possibilities, possible outcomes, and what would be the flip side if it didn't turn out to be as bullish as it looked. And we have lots of other things to talk about. 10-year yields are down 5. The dollar is 104.30, up 12. S&P 500 is 55.83, down 16. The VIX is 22.87, up 63. Gold is 31.32, up 9. Silver is 13.83, down 26. Copper is $5, unchanged. WTI is 71.56, the big surprise for Trump, I think, down 4. Natural gas is 406, down 5. Surprised in the sense that oil was very strong yesterday. Bitcoin, 83,900, up 1,400. That's interesting. Palladium, 983, down 6 and change. Platinum, 990, down 4 and change. Gold, silver, stronger. Tariffs go into effect, I think, and go a lot higher. Soybeans, 1011. Corn, 454 and change. Wheat, 548, it looks like, up 2 and change. Okay. Pre-tariff behavior. I wouldn't put too much into today's activity so far. Yesterday's activity, however, I think was a big indicator of how the market is looking at things, and that is recessionary with a side order of stagflation. All right. There's the home page. Tons of stuff being put out there. The market's busy. You've got to respond. Okay. Featured. Yesterday, we did a guest post for Scottsdale Mint. It's premium content, and we haven't published it here. We wrote it specifically for them. And the title that they put on it was Gold Source 4% in 5 days. Here's why. It's a pretty accurate title. Bank of America's 3,500 gold thesis, structural demand, policy uncertainty, and the currency wars to come. It's a very detailed explanation of the Bank of America report. Different than the explanation that we've given before, but you'll find if you're a premium subscriber, largely the same. If you're not, however, you probably want to go over here and click that because, well, it's there. Moving down, gold miners, Citi makes the fundamental case. Really, really good slide deck. Just a slide deck, but the kind of things you want to hear if you're a fundamental analyst in an industry that's being awoken to. Founders, April 2nd may not reduce uncertainty at all. That's a Goldman Sachs trader, probably one of the most important traders on their desk, describing the outcome from tariffs tomorrow. If you're not familiar, even at the founders level, he's channeling what Hartnett says, but more tactically. James Rickards, Mar-a-Lago, and the 3 previous accords, that wasn't his title, that's our title, but he talks about why the Mar-a-Lago Accord would not work, something that we had said as well. Founders, full court mining press, that's the Citi report plus more. The coming squeeze on U.S. consumers, and silver squeeze goes global. That's yesterday. Let's go to the analysis of the market, okay? Fresh all-time highs and a quarterly all-time high close. Gold closed the quarter at an all-time high, March 31st, which is an indication that more buying will come in. Fresh quarter, fresh buying, and that may happen today. That's happening right now. The chart you're looking at there, as convoluted as it is, tells a very clear story. That chart, let's see if we can make it bigger. It makes it smaller. Bummer. All right, well, that chart, we'll just zoom it. We'll just roll down a little bit. That chart represents gold going back, since I think the 70s. It's a zero hedge chart. And the dispersion of rates of return going through the year. And at this point, using every year that gold has traded and was recorded on futures, the gold market is up the most it's ever been at this point in the year. This is where we are, and this is where we could go on any number of paths. The mean would be in here somewhere, right? So this is probably the highest gold's ever been at this point in the year, meaning April 1st, ever in terms of a rate of return. And well, I think the next closest year is 1986. So make of it what you will. Yesterday's activity was amazing. In fact, it was amazing that it wasn't even higher given the volume that traded in the April contract, which brings us to that. Yesterday on the COMEX, open interest went up by approximately 65 to 70,000 contracts. The interesting thing about that was that over 45,000 of those newly executed contracts were in the April expiration. We have a full explanation of this extraordinary event, as well as the way to handicap what is most likely to happen next in premium at bottom. And we're going to do the premium unlocked for subscribers today. Everyone can see it. Give you an idea of how those go down. Here's the chart, right? This is by Craig Hemke. The red markings are by Craig Hemke. The green markings are by ourselves. The red markings cover April. April open interest went up 45,420 contracts, essentially doubling the open interest in one day when it should be going down. So open interest, I'm sorry, 62,000. I said 65,000 to 70,000. 62,000 was the number. Now, this is yesterday's data. They could have changed it. There could be something grossly wrong. That happens at CME from time to time. But let's assume for the rest of this conversation that the data is accurate. And let's also assume that the person who did the trade wanted to do the trade, because if they didn't, it would be really hard for them to not do it. All right. We're going to get into the explanation at the bottom. So let's move on to the next point here. Tariffs tomorrow. The only thing we would like to add is tariffs are supposed to go into effect tomorrow. And while that could be a wild card for U.S. markets, stocks as well as gold, in either direction, that genie is out of the bottle with regards to gold. Even if Trump pulls back or Europe capitulates in some way, or even China, which I doubt would happen, capitulates, well, you're now in a situation where tariff or no tariff, you're not interested in holding dollars any more than you have to. Considering that tariffs are an anti-room for sanctions, an on-ramp, if you were in the process of de-dollarizing before and your trade with the U.S. is decreasing anyway, because you're trading more with your brothers over in the BRICS, well, you're going to de-dollarize faster and you're going to buy something as a substitution for those dollars, and that would be gold. Now, that's a clip of a chart we put together inspired by some work we did with our students. It's a flow chart with some decision nodes, and it basically describes the path that we will go on once these tariffs are imposed from beginning to end. So there's printing money, not printing money, and recession, not printing money, and Goldilocks or transitory inflation, which is a Powell phrase. Anyway, we borrowed the concept from a chart that we saw by Dario Perkins at TSL, and we made our own in a little bit more academic sort of appearance. We have that chart at bottom. You can use it like brackets for the NCAAs, okay? It's the path of paths that we have going forward. Anyway, that chart is at bottom, as we just said. Moving on. In market news, we just threw up an excerpt from a Zero Hedge post today because, well, I mean, all the news is bullshit, except for this, right? So tactical tariff thoughts, JP Morgan's trading desk, which they're the guys who call the October 22nd low in stocks. They're the guys who I think it's the Alpha Team or Alpha Desk. I'm not sure what their name is, but anyway, they're the guys who basically got uh, what's that guy's name? Fired. The head analyst at J.P. Morgan. I forget his name. Anyway, Greek name, I think. He left because these guys were right. Most investors are operating under the assumption that tariffs are temporary. Further, that a Trump put is thought to exist in a 5,000 to 5,300 range for the SPX. So based on how the options are flowing, based on how the futures and stocks are flowing, uh, they see that the market is handicapping somebody to bail out stocks if they go, the S&P goes below 5,000. So there you go. JP Morgan's Andrew, again, paraphrasing just a tiny bit of this report, of this analysis. Head of JPM's trading desk, the same one that called the October 22nd low, right, writes that, quote, policy uncertainty is the dominant factor in the markets and that neither the Trump put nor the Fed put activate in the near term. We're going to just add in something Goldman Sachs said. April 2nd doesn't necessarily have to bring certainty either. It could increase or fan out uncertainty. All right. That said, one potential event that could break the bearish outlook is the announcement of a trade deal or framework of one with a G7 country ahead of the announcement. Right. That's the whole point. Trump doesn't want to have to do these things. He's hoping someone says, I give. He wants someone to cry uncle. That's from a note by Zero Hedge called Tactical Tariff Thoughts. Longer title than that. But that's one of their premium subscribing products. Data on deck NFP is this week, but today is PMI. Tomorrow is factory orders, but more importantly, it's the announcement of the tariffs. Look for a reprieve today. Won't necessarily happen, but you never know. Services PMI is on Thursday, and non-farm payroll unemployment is on Friday. And arguably, once the tariffs are announced, if the non-farm payroll comes in low, a lot of people getting fired, then people are going to start looking to PAL to ease. So it's like the Trump put is, I changed my mind. The Trump put doesn't happen, then you have the tariffs. And then the jobs number comes out really low, perhaps, and people start to look to PAL for his put. Anyway, we'll see how that goes. All right, quick look at the markets. There's the gold. We'll just throw the gold weekly up, right? There's the gold weekly. Very nice to see. Here's the daily. I'm going to throw up poly markets today. All right, so there's the daily. Poly markets is as good as it is. There's no help on the daily. And that's because we're just making new all-time highs all the time. However, if we were to drop, 30.47 is your support. I mean, if we were to really drop, $100, 30.47 is your support. Silver, a little bit more nuanced. You may be saying, why is silver not going up? Well, number one, silver has been ahead of gold for the first 2 months of the year. Number two, silver is not being bought for central bank delivery like gold is. And so I said it before, they're continuing to sell silver to buy gold. Now that is blowing back in their face in the London markets for sure. But it doesn't mean it's not happening here and continuing to happen here. Now, on that note, the tariffs are economically bearish, okay? Stagflationary or gold bullish. So if tariffs are bullish gold and bearish for the economy, then gold should be higher, okay? And stocks should be lower. So what happens to an industrial commodity like copper? Well, if the world gets depressed, then copper will go down. But before that happens, people will buy all they can, front-loading in anticipation of the tariffs going in and prices going up. Will the increased tariffs raise the price of copper worldwide? If demand stays the way it is, yes, because we will pull copper at higher prices, and the copper that's out there at trading at lower prices will start to go up to match us because our demand is significant. Probably not the biggest demand anymore, but it's probably number two. Silver is an even more interesting and less understandable asset. A 25% tariff on silver from Canada and Mexico translates to about a 5% increase in spot. Okay, so 25% on finished goods, let's say you're getting a finished silverware set, 5% translates to the bottom line in silver. So I don't even think we've seen that because, again, I think people are selling silver to buy gold. And that's what happened yesterday. You can look at the poly thing there. There you go. The high is the range high, and it's actually pretty easy to see on a daily. That's something that I would draw. But the nuances are on an hourly basis. I would draw a line there, 3361. Let's see what the algorithm says. 3361 going, doesn't agree with me. Probably agrees with a lower time frame. All right, so the market is captured in sideways right now. I would say you're comfortable above 3361. Anyway, if you zoom out a little bit, you'll see what I'm talking about. Silver is on its own trend, and it was ahead of itself. Now it's below. And I still believe that let me hide poly for a second there. I still believe that's the weekly. This gets you that, okay? Provided we don't go below here. That's it. But it's taking a lot longer than I thought. And that's a little bit scary. All right, let's move on to the premium section. And for the premium section, I get to be a little bit less formal. All right. All right, so yesterday, I did a voice recording and then I scripted it out. So it's going to be in the first person. So yesterday on the COMEX, open interest went up by approximately 62,000 contracts. The interesting thing about that was that over 45,000 of those newly executed contracts were in the April expiration. What follows is a potential explanation. This is for the geeky types, all right? Especially my buddies on X that are talking about this now. I want to give them something to go out and figure out more about it because this is the framework that happens historically. All right. The reason that's interesting is because the April expiration as of Friday is now in liquidation mode. Expiration mode occurs on the first notice day or liquidation mode. I was probably just saying the wrong word there. First notice day is the day after which, if you are long the contract, you must indicate your intention and prove your ability to finance taking delivery of that contract. If you do not declare your intention, you risk your contract being liquidated without notice. This is not tourist stuff. If you declare your intention as a buyer who wants to take delivery, then you must pony up the money to make delivery between first notice day, which was Friday, and expiration day, which I believe is April 28th this month. Subtitle, Futures versus Physical, What the Spike Could Mean. The reason the open interest increasing is so significant, I mean, I can't say the word so big enough, after first notice day is because, generally speaking, futures contracts are where directional speculators play, and physical contracts are where the deeper pocketed physical players play. For the open interest to increase, essentially double on a day where it's supposed to start decreasing, is an indication that someone either truly wants the gold or is an extremely deep-pocketed player who intends to spoof the market higher. Again, this is all against the backdrop of the data that we viewed yesterday was actually accurate as published by the CME. Now, the open interest in the April contract going up by over, that's a typo, 45,000 contracts is indicative of someone saying, I would like to take delivery of 45,000 contracts. I have declared that intent and I have the money to do so. To the best of my knowledge, I have never seen that happen in the gold market in my 30 plus years of experience. I have seen similar behavior in other markets. I was trading actively as an options market maker, oil and natural gas, but not gold. Delivery risk and short squeeze scenarios. The point is, it's never happened before, at least to my knowledge. What could happen from here are any number of things, but the path forward will continue to narrow as each day goes. So, for example, the purchaser of these contracts could just hold them, put the money up and say, I want the gold. And between now and April 28th, whoever is on the other side of those contracts, the short has to come up with the gold, has to source the gold. That could cause a literal short squeeze in the market if the short counterparties of that new long trade don't have access to physical metal. We think they do. That's a different story. The second thing that can happen is something that was done frequently in oil over the years from time to time. Bullish players, on occasion, first of all, the futures markets are rigged to prefer the shorts, not the longs in any market. That's to protect the industry. It's not to run you in. But from time to time, bullish players will sense an undercapitalized short contract holder who is stressing for one reason or another to come up with the commodity. It would be an oil producer or a miner. It could be a bullion bank. It could be a hedge fund that's short and just hasn't gotten around to covering it. They're just hoping, those shorts, for the last second profit. And that happens in the situation. When that happens in a situation, the bull buys the contracts going into first notice day, signaling three things. One, he has the money to buy them. Two, he declares that he wants to buy them. And three, you better have the commodity soon. The clock is running on you now. He's now long the option. Then it becomes a game of pot bluffing. He has the money. He's proven it. He's declared he wants to take delivery, and you, the short, have to find the metal in this case. The short's options, chairs are running out. Time is running out. Musical chairs are running out. Now, the short can do one of three things. If this is the game being played, they can have the metal, right? They can what's called, well, not reissue. They can go into the market and buy the metal back. But this becomes increasingly difficult to do because the contract that they're looking to buy is in liquidation mode. And there are fewer and fewer people who wish to be sellers of that contract. They've moved on, okay? In 20 days, 15 days, 10 days, 5 days, it will necessitate them having to get the metal. They're running out of time. So it becomes a pure replication of an analogy that I've been using here. It becomes musical chairs, and there are less and less and less chairs. And by April 28th, there are only one chair left. And one chair is owned by the person who wants to take delivery, and he's about to sit in it. The other chair, which is about to be pulled, it's a horrible analogy, but I'm using it wrong, but you get the idea. The point is, time is running out, a chair is being pulled away. The guy who needs to come up with the metal needs to find another chair for you to sit in, or you're going to sue his ass. So you could see how this becomes a game of chicken, another analogy, as we go forward towards April 28th. Default risk and the long's exit options. The third thing the short contract player can do is they can default. And that has happened. I haven't seen it happen really publicly. You could also roll the contracts, but that's another conversation. Anyway, at this point, the long who's squeezing, this is a short squeeze, who's squeezing the short takes his profits by selling into the rally. Or he doesn't take his profits and he takes delivery. Or he sells a deferred contract and puts on a spread for a credit or a profit. So we've covered the first two things that the buyer can do. One, the buyer can take delivery and say, I don't care, right? B, or that's one, right? A. B, play like he's taking delivery and actually be able to take delivery if he need be. But what he's doing is he's just squeezing someone on the other side of the trade. Or C, he can sell out the next day or any of the other days between now and April 28th. Now, you may be asking yourself, well, he declared he's declared he can take delivery. But if he wants to sell it, he can sell it. But when he sells it, he's selling it to who? It's just going to keep dropping because nobody cares about the market anymore. So it is a big game of chicken. To be clear, selling out the next day would be incredibly risky for him because anybody who bluffs and then has their bluff called and then changes their mind, the market will punish them, right? Like potentially $100 lower punish them. And anyone who does that, who reverses a position like that after being fully vetted for the money and after all that, after being fully vetted for the intent, right? Well, they would open themselves up to an investigation as well. That is straight up manipulation. And bull manipulation gets investigated. So who is the buyer? Which brings us to the question, who is the buyer? Nobody knows, but it's not a tourist. It could be a bullion bank. There's a lot going on at the bullion bank level. There's a rotation of shorts. There's a covering of each other's backs, all to keep the market orderly and to save their own asses. Also, Well, there are real whales out there. Now, could this be China buying? I've heard that mentioned, taking delivery. Could be, but I doubt it. In the USA, no. Could this be a US Treasury taking delivery? Could be. Could be a combination of people, some of which are serious, some of which are just piggybacking. Could be. Happens a lot in other markets. However this plays out, it will signal a couple of things. That the market is now good enough for people to consider manipulating it higher. Weird prize to have, but that's the truth, right? Or the market is big enough and gold is important enough that the bulls are equally, if not better, capitalized than the bears. Yeah, you know what? We'll take delivery. Screw you, right? And the COMEX is turning into a physical market, completely replacing the LBMA. That, I think, is the thing you can bank on, cynicism or not. We believe the LBMA is losing its grip. To note something that Tom Luongo said a couple of years ago to me, the removal of LIBOR and the replacement of it with SOFR on the rate front was the beginning of the end of the European or UK dominance in the financial world. Well, the LBMA squeeze, whether it be logistics or because the bars are heavy or because they simply don't have the unencumbered metal lying around, and they don't, that's just a fact, that's another conversation. The power that the London Exchange, it's not even an exchange, it's the London Association, right? That's what it is. It's an association. The power in London is waning. And the physical market is moving to the US. That's where the gold is going. Obviously, this is a transcript of something I said, right? Anyway, stay tuned. There's a cursory overview. That's a cursory overview of how to view this, right? There will be more to come as we know more. If you're looking for a path from here on in, every day that the long of those contracts does not sell out is a day that the short of the contract must come up with it. One other thing, my guess is this is how these things go down. This is basically a massive block trade, right? My guess is the players knew this was coming. And while I wouldn't call this prearranged in a negative way, I would say this is a situation where someone really wants to use the COMEX as a physical exchange. And in order to do that, you have to coordinate with other players. Not unlike what happened in 1999 when I was trading natural gas options, when the whole merchant energy, Enron, El Paso, they all blew up, and the exchange became where everyone started doing block trades. So kind of like this. Hey, I'd like to take delivery of 49,000 contracts. I'll give you a year to do it. And the year goes up and they're ready to do it. And that's what happens, right? This is the nature of prearranged legally block trades and the over-the-counter market that work their way around the physical market. The broader market view, I think I said that up top. There's the chart. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.